Okay, it's just about 11 a.m. At least that's what I have here. So we can go ahead and get started. Thank you for joining us for our webinar today. What I had hoped would be our last COVID webinar. We've had, I just counted actually 27 COVID related webinars since March. And we were hoping this wrap up would be the last one, but as we speak, we have new legislation on the horizon. So I would anticipate continuing to have these COVID webinars and maintaining our COVID-19 page, which we've had on our website, at least for a little while longer. Just some housekeeping items. All participants have been placed on mute, and you will receive a follow-up email with a link to the recorded webinar and a copy of the webinar. We also post this on our webpage. And at the end of this, I will give you our email addresses. So if you have any follow-up questions, you are more than welcome to email us directly. So I'm very excited. Most of you know me at CTR, but I'm very excited to have Mike Radich on the call with us. He is the founding shareholder and president of MGR CPA and Consultants. He's going to talk with you about some information on PPP loan forgiveness, some updates there. Mike, do you want to say hello?
Hi, everyone. Thanks for joining us this morning.
All right, so on our agenda today, the first thing I do want to cover is there are some important things that are ending in just a few weeks here, December 31st. One of those things is the Families First Coronavirus Response Act. That leave is ending. So we want to make sure that you're prepared on how to handle this with your employees, and then also how to handle this with CTR. There are some things we're going to need to do. I want to talk about the proposed new COVID relief bill. That was just released, a draft copy of that on Monday. So we'll give you some highlights there, but of course that could change because it's still in negotiations. And then Mike's going to talk to you about PPP loan forgiveness. And then lastly, we want to touch upon that employer Social Security deferral. That is also ending this year, and we need to talk about repayment and how that works. So let's talk about the FFCRA. So the Families First Coronavirus Response Act, it requires covered employees with less than 500 employees to provide eligible employees with up to 12 weeks of paid leave. There are a lot more details to this. Of course, for the emergency paid sick leave, employees who have symptoms of the coronavirus, or who are required to quarantine, get 80 hours of leave. And honestly, you know, a lot of our clients have not had to use these codes, but with the latest wave of COVID, especially in and around our area where our corporate headquarters is in Pittsburgh, we're seeing more clients than ever calling us asking for the codes to be added. Well, you know, the frustrating thing is just as quickly as you add these codes, we're going to have to start taking them away, because the leave expires on December 31st, unless this is extended or amended. And based on, you know, my research of this proposed bill that's out there, there is not any mention of extending this FFCRA leave. Of course, we know that anything can happen at the last minute, and we're continuing to watch. But as of now, we're not seeing any change on that front. So there's some important considerations that you need to take, you need to start thinking about right now if you haven't already. So if you have an employee who is out on leave due to COVID after December 31st, you will not receive a refundable tax credit from the IRS. You cannot claim this as a refundable credit. The FFCRA does not require employers to pay out any unused FFCRA leave. So what happens? It just goes away. If you are a CTR client, you cannot enter hours into our FCRA COVID leave earnings for payrolls with a check date in January. And actually, I want to explain that a little better because we have since just reversed this a little bit before our webinar, and I'm going to clarify that on the next slide. So how can you prepare? Number one, you need to remind your employees that the leave entitlements are ending. So we suggest that you send a reminder to employees, especially those that are actually out on leave, that this is not FFCRA leave after December 31st. This is especially important for employees who are taking FMLA leave to care for a child, because if you are requiring them to return, they're going to need to plan in advance. We need to update our leave policies to remove the FFCRA leaveability. So some of you may have absence codes out there. You may even have the ability in ISOL for employees to go and make a request for this leave. You're going to need to talk to us and make sure that that is removed as of December 31st so that employees aren't going in and requesting this and it isn't approved. If you added a policy in your handbook, you're going to need to make sure that you remove that policy and think about how you are going to handle these absences going forward, because there are still, this isn't going away. There will still be people in January that are going to be needing this time off. So you may want to, so there are some options. You may want to let employees know that this time will then be taken from their sick leave or their existing PTO policies. If employees don't have any time available, you may have to grant unpaid leave. One thing that you need to take into consideration, and that's actually on this next FAQ slide, is there are some cities and then also states that are enacting emergency paid sick leave. And Pittsburgh is actually one of them, and I'm going to talk about that. So that is something you need to keep in mind. So what happens to employees that have existing FFCRA leave balances? And the answer is nothing. It is eliminated if an employee is only a few weeks into FFCRA covered family leave to provide childcare due to his or her child's school closure. The employee's paid leave entitlement terminates on December 31st, regardless of whether the employee has used all of that leave or not. Now, that doesn't mean you have to terminate it. You, as the employer, can choose to let that employee still have paid leave, but it's basically, you're not getting a tax credit for that. So you can still choose to offer leave. You can still choose to not have it impact their PTO or their existing sick leave. But again, you can't claim that tax credit under the FFCRA and under those codes. What if I have an employee that's still out on the emergency paid sick leave or extended FMLA leave? Advise the employee that the leave past December 31st will be applied to the employee's existing PTO or sick leave balance. And again, as I mentioned, please be aware that states and municipalities are enacting their own COVID paid sick leave policies. So you may actually be required in some instances not to take it from their existing PTO or sick leave policy. And I'll get to that on the next slide. And then also keep in mind that if an employee has a serious health condition or is caring for someone with a serious health condition, that employee may be eligible for FMLA. And the Department of Labor has indicated that employees who are sick due to COVID-19, where complications arise, may be eligible for traditional FMLA. So an employee that has a serious health condition, they are entitled to 12 weeks of FMLA leave if you are an employer that's covered by FMLA. So you have to make sure that you offer FMLA and you're covered. And you're going to need to go back to those original FMLA leave rules and just make sure that you're not in a situation where it would be FMLA leave, and you need to hold that employee's job and give them that unpaid leave for the 12 weeks. So just keep that in mind that FMLA could come into play. The other thing that you need to be aware of is how to handle the FFCRA leave in the last pay of December or the first pay of January. So what will likely happen with some of you is if you have a bi-weekly pay period that begins in December and extends into January with FFCRA leave that was taken in December. So you could have an employee that was out on COVID sick leave that last week of December, but the check date isn't until January. We're going to let you go ahead. You can add the leave in because that employee is still entitled to the leave, and you're still entitled to those tax credits for the December leave that is a part of that bi-weekly payroll with the check date in January. After you process your payroll, CTR will make the adjustments behind the scenes to move the tax credits for the FFCRA leave to your fourth quarter 941, so you will still receive the tax credit. But it really is important for you to remember, because those codes will still be out there in January, because we still need to process these tax credits for you in early January. Do not use the FFCRA codes for any payrolls that are just 2021 hours. So you can't be using it for any January payrolls past those ones that include December time. I know this is confusing, but we haven't been given really any direction on the best way to handle this. We've talked to several payroll service bureaus, and this is the best way we can think of to handle this, so we can still get you your credits for the part of that pay period that was actually in December. But just make sure that you're not using those FFCRA codes for those payrolls that are all time worked in January. If you have questions, feel free to reach out to me, and we're happy to help and answer any further questions on that. So I did want to address the Pittsburgh COVID-19 sick leave ordinance. So we mentioned, what are some options for you? Well, after December 31st, you can have these employees take the leave from their existing PTO or sick leave buckets. But there are some states, for example, that have enacted their own sick leave policies. And here in Pittsburgh, they have just enacted the COVID-19 sick leave ordinance that was signed into law December 9th, 2020. So this applies to Pittsburgh employers with at least 50 employees. And what this is saying is that leave must be provided in addition to any other existing city paid sick leave policy. So if you remember, Pittsburgh enacted back in March of 2020 their own paid sick leave policy that required you to provide paid sick leave to your employees. Now, if you already had an existing PTO policy or sick leave policy that met the minimum requirements of the Pittsburgh paid sick leave, that was fine. You could use that policy. Now they're saying for the COVID sick leave, this is leave that must be provided over and above your existing PTO or sick leave policies. So really, it's just kind of an extension of the FFCRA sick leave that you've been using. The only difference is you are not getting a tax credit for this, because this just deals with Pittsburgh. The FFCRA leave is no longer in place. So I hope that makes sense. Now, of course, this just applies to Pittsburgh employers. And let's talk about some other areas to qualify. So employees who have been employed for 90 days would qualify. Employees must work in Pittsburgh, or they usually work in Pittsburgh but are teleworking due to COVID, or who spend at least 51% of their time in Pittsburgh. Full-time employees who work at least 40 hours would get 80 hours of paid sick leave. So this is the same as the FFCRA leave. Employees who work fewer hours, the amount is based on their scheduled hours of work. So if they're normally scheduled 20 hours a week, then you have to apply it based on their scheduled hours of work. And then variable hour employees, you look at their average scheduled hours in the last 90 days. So this is very similar to the FFCRA leave. What are the reasons for leave? A health care official determines an employee who is exposed to COVID or exhibits symptoms would endanger the workplace. This is regardless of whether they're diagnosed with COVID. The care of an individual that has been exposed to COVID or is exhibiting symptoms. Employees diagnosed with COVID or exhibiting symptoms to seek a diagnosis, or if they need to self-isolate. So it is a little more broad than the emergency paid sick leave of the FFCRA, but it's really like any reason that they would need to self-isolate because they feel that they have symptoms that are related to COVID. How long is this in place? It's when the state of PA or the city virus-related health emergency ends, whichever is sooner. So I think the moral of the story here for everyone is we don't have the FFCRA anymore. There are going to be different sick leave policies if this doesn't get extended that may be enacted. So it's important to keep an eye on those things at a local and a state level. And I think the gist of it is just applying your leave policies pretty liberally going forward until we have something else in place. So let's talk about the proposed pandemic relief package. So that's being negotiated this week as we speak. The highlights of this unemployment assistance. So Trump's executive order, it added $300 a week in additional federal unemployment benefits. This ends December 31st. So they're looking to extend this benefit by 16 weeks from the end of December. The extended PPP program, this has bipartisan support. So this looks like it may very well go through with some adjustments here or there, but added about $300 billion to the PPP for small businesses, targeting aid for businesses hit hard by closures, specifically restaurants. It's in its current state limited to businesses with 300 or fewer employees with 30% revenue loss in any quarter of 2020. Small 501c6 organizations that have 150 employees or fewer, such as local chambers of commerce, economic development offices, tourism offices would become eligible. Also looking at a simplified loan forgiveness process for PPP loans of 150,000 or less. Additional help for renters. So rental assistance funding. This funding would provide financial aid for landlords to prevent evictions. This was controversial, so we'll see if this goes through, but liability protections from COVID-19 lawsuits. It would be a 6-month moratorium on some coronavirus lawsuits to protect businesses, hospitals, other organizations, basically looking for a moratorium on those lawsuits so that the states can get their own protections in place. But again, this one is a little more controversial, along with state and local aid money. That is another one that it seems to be a little more controversial. There was something in there I thought was interesting. Child care providers, $10 billion to support child care providers struggling due to the COVID pandemic. And then also on the table was an additional proposal for stimulus checks. There is support from the White House on this, $600 stimulus checks to individuals or $1,200 to those filing jointly, but we are not sure whether that will actually be passed. So as soon as we know what the final result of this is and if it passes, we will update our clients. So with that, I'm going to turn it over to Mike Radich. So Mike Radich is the founder and shareholder of MGR CPA and Consultants. They are a great referral partner of CTR. We do have mutual clients. Hopefully some of you are on this webinar as well. He has 17 years of experience and has some really interesting things to talk to you about today. He is located in North Hills, so very close to us here at CTR. Um, and I'm excited to turn it over to Mike.
Thanks, Bridget. Thanks, everybody, for joining us today. This has been a question I know that I've been walking through with a number of my clients, and I felt like it was important enough that we would talk about it because, conventional wisdom would say, well, we got the PPP loan this year. We want to apply for forgiveness before the end of the year. That way, everything closes out in the 2020 tax year, and we can put this all behind us. And truly, as a profession, we're saying that might not necessarily make a ton of sense. So just a couple of the basics is, if you received funds from the PPP and you used at least 60% of those funds for what they would consider qualified expenses, which could be payroll, including any employer health benefits, contributions to retirement accounts, but also non-payroll expenses such as rent, mortgage interest on your building, and utilities. When this was initially passed through in the CARES Act, there was basically, you had an 8-week period to disperse the funds, which was a little bit difficult for people because there was a number of qualifications that you needed to do to make sure that owners weren't overcompensated and things like that. So they did extend it to a 24-week period for forgiveness application. And again, when the PPP was initially passed, you had to use 75% of the loan on qualified expenses, but obviously they lowered that in June to that 65%. Basically, what we're looking at as a profession is, what can we see the Congress doing over the next couple of months? So basically, if we know that we had the 8-week or 24-week period for disbursement. If you look at your actual PPP documents that you receive from your bank, you can apply forgiveness up and until the maturity date. So there's not necessarily a reason for you to hurry up and try to get this PPP forgiveness in before the end of the year. If you go in and I think with what's going on right now, as we look at a switch in administration, and we do see some indications from the Congress that this new relief packet will be released, and that part of that could be that there would be significant changes to the PPP forgiveness application. So the form that you use, it's SBA form 3508 or 3508 EZ. The EZ is a streamlined form. So the actual forgiveness application is roughly 11 pages long. I think the EZ is 7 or 8 pages long. But there's a lot of other disclosures and things like that they've quote unquote streamlined if you received $50,000 or less from the PPP program. Bridget, if you wouldn't mind advancing me on here. So basically, right now, the American Institute of Certified Public Accountants, along with a number of state accountancy boards, are pushing for, and it has been generally well received, that those rules are changed to from anywhere up from $150,000 to $250,000 being able to use the streamlined process. And then as we deal with these income tax considerations, so the IRS basically came out with for when the CARES Act was released, and they issued IRS Notice 2020-32, which basically walks you through whether or not the funds that were used to pay qualified expenses and that are forgiven under the PPP arrangement in the CARES Act, if those expenses would be deductible. So in general, CPAs, we follow the Internal Revenue Code section 162 that allows deductions for ordinary and necessary business expenses. So that's just anything really that you need to do that would be in the ordinary course of operating your business. But the IRS is strange in that not only does it have the IRS code that it follows, but there's also different rules that it applies on a case-by-case basis. And in this particular instance, they use what they call the tax benefit rule. And basically the tax benefit rule says if you receive income that's taxable, if you have to pay it back, it's deductible. If you have expenses that are paid and they are deductible when they are paid, they are taxable when you receive them back. So if you look and you really get into the nitty gritty of the CARE Acts, you go into section 1106I that says basically at the end of the day, if you apply and qualify for the PPP forgiveness, the PPP forgiveness is excluded specifically from your taxable income. So based on the tax benefit rule, what they're saying is if the forgiveness is tax exempt, then the expenses that were forgiven, that were paid by those funds, would now become non-deductible. And so you have a situation where this is the AICPA, the state accountancy boards, we have been petitioning pretty hard, and the Congress has been receptive to the idea of passing legislation in this new coronavirus relief package, basically that allows for basically a double dip benefit for businesses affected by this. And what that double dip would be is that you would be able to remove the loan forgiveness from your taxable income, just as it's written in the act. However, you would also be allowed to deduct those expenses on your tax return because of the extraordinary circumstances surrounding COVID-19 and the additional costs and burdens that it has placed on people, and particularly businesses. One thing that I've been talking about with my clients since March has been that any additional expenses that they are experiencing because of COVID-19, what I've had my clients do, or the clients that we do bookkeeping for here, is we have added a new COVID-19 expense item under other deductions. And the reason for that is because we do believe that the extraordinary nature of what has happened this year is likely, hopefully, not to repeat itself anytime soon. And the reason why I've given that advice to my clients is I believe that if you would go for a loan from your bank or another institution, I would say that the expenses that were incurred because of coronavirus should be added back as you would with bank interest or depreciation, income taxes, things like that. So if that's not something that you're currently doing, it's a little bit outside the scope of what we're talking about here, but it does kind of go hand in glove. Clients that I've been doing consulting with for COVID-19, I've specifically given them invoices that break out what my usual fees are. And then, there's another line that says, COVID-19, and it lists the things that we had done and gone through that. So then we have a situation now where, would you mind moving me forward one more, Bridget? Thanks. So all of this is, why do we want to wait? Why don't we just want to be done with this and move it, into our, let's just be done with it and move on. One of the biggest reasons is right now is any guidance that's coming out, and this is as of December 11th, so it's as recent as Friday, the guidance is still considered interim, meaning that there's no final determination have been made on how we need to move forward as we go through the forgiveness process. The other things that we have been running into Some lenders have opened up their PPP forgiveness portals. Other lenders have not, because truthfully, because the rules and regulations are still considered interim, they don't necessarily know what they have to do. And while your banks will be required to calculate the forgiveness amounts, the ultimate responsibility is going to lie with the taxpayer and the folks within their organization. And because we don't know what information is needed in terms of, if they do change the rules, there could be a streamlined process. So let's say that we have a situation where the administration changes over in January, and the new Congress and Senate is sworn in, and everything is, so we have a President Biden, we have a House of Representatives that is controlled by the Democrats, and a Senate that's controlled by the Republicans. It's very likely that there's going to be a bipartisan bill that would likely allow us to calculate the forgiveness easier, depending on the number of dollars that you received. But also, if they do pass that extraordinary deduction of expenses, if you apply for the PPP forgiveness right now, you're locked into the rules as they were written at the time that the application was submitted. They don't go back and allow you to apply in one period and then change the application for the rules that were more favorable later. For those of you that have already submitted a forgiveness application, I have been looking and haven't found much guidance on if there's a way to call back that application. That's probably going to be something that's going to require some more digging. And that way, but what I'd like to do is be able to come back and tell you, here's what we need to do to pull that forgiveness application back. I would be willing to bet that if the forgiveness application was submitted and approved, there's not going to be anything that we can do to change that. But we do have an anticipation that this double dip in the new legislation is likely to happen. Both the Senate and the House are very open to it. So is the Biden administration. We have seen with the nomination of Janet Yellen as Treasury Secretary, she has been a very vocal support person for business-related COVID relief. So less of us as individuals getting $1,200 or $600 checks, but ways to ensure that small businesses can continue to operate through this, because it probably does appear that on the horizon there is going to be a number of businesses that won't be able to weather the storm. So we are hopeful that this will pass in the new administration. I don't necessarily see anything happening before Christmas, though. The news does seem to be hinting that everybody's come to terms before the Christmas break. There may be some issues that come up that it might be the right idea for you to go ahead now and apply for forgiveness. A lot of these would be outside. I don't think anybody would want to hear me talk that long. I know that I have helped a couple churches get PPP funds. In Pennsylvania, churches don't file a tax return, so there's not going to be any tax implication that would be to be considered with something like that. And it could also be that way for certain nonprofits, but it's certainly a case-by-case basis. If you are in the position where you are in a company that's being acquired, we do have a situation where a client is being acquired by a Japanese company and they want to close the deal by December 31st, so that January 1st, this is an entity of this other company, as a division. And so that is basically causing the need to file for the forgiveness because the entity won't exist anymore. And then also, if you receive PPP funds and let's say that you're, a single member LLC or a sole proprietor that has employees, but you have decided that based on the advice of your attorney or your CPA that you're going to change your entity structure, again, that warrants a conversation because the rules are unclear about how that would be treated for the successor company purposes. So there is just a ton of information coming at us. I mean, we've kind of spent all of 2020 drinking from a fire hose about all of this. But it also has appeared that the SBA is also willing to be a little bit more liberal in application of things. Again, with the situation that we were encountering with this client that's being acquired, there was no federal shutdown, but there was the additional state shutdowns, and the SBA is taking those shutdowns into consideration for the streamlined process and things like that. So that is where we are right now with this. I was kind of hoping that we would see a little bit more movement if they were going to be able to pass something by the end of the year before they go on Christmas break. But there's a lot of talk that we're close, but no cigar. So it's a little bit difficult to give you any certainty of what may come next. Just that the both the Congress and the Senate and the incoming administration are keen to help small businesses through the challenges that are likely going to plague first quarter 2021 as well.
Thank you, Mike. I think this is an interesting perspective for our clients. I do know that we have helped several clients prepare loan forgiveness reports and apply. So I know that there were some clients really pushing just to get this off their books this year. And for those of you who haven't, I think it's a nice perspective to see why there's not really a rush to get this in. Now, one thing that I just wanted to ask you, Mike. So I guess from the standpoint of a client that had, maybe they had a $500,000 PPP loan. So the fact that this is not deductible, it essentially means that tax payment next year is reducing really essentially the loan that they got. Is that an accurate statement?
Right. So if it would stay the way things are written, basically what would happen is so if you got a $500,000 PPP and $500,000 were forgiven, that is basically an increase in your taxable income of $500,000, which is pretty substantial for most of us. That could really change the tax. It's obviously going to change your tax bracket. It's obviously going to change a lot of, the fourth quarter planning that your CPA should be doing for you. So it could bump you up into the top bracket. We just don't know.
Yeah. Well, I really appreciate your feedback, and we will be providing Mike's contact information at the end of this webinar if you had any other additional questions related to some of the things that he mentioned today. Just a reminder for those of you, we do have the PPP loan forgiveness report in iSolved. Many of you know that already. Again, some of you have already used it. If I move forward here to the next slide, you can see that in this example, it actually fills out PPP Schedule A. This is the actual, not the easy application, but this is the full-blown application, and it shows you how it puts in each of those amounts, and then you can just transfer them to your application. And it also has all of the supporting payroll information that you need to apply. So, it does take some tweaking on our side. Sometimes we need to adjust things in iSolve to make sure that some of the data is accurate. But it's a good idea to at least take a look at it so that when you're ready to apply, we can have everything cleaned up for you and get you the documentation that you need. The next thing I want to talk about that is coming to an end at the end of this year as well, and this has been very popular for our clients. We have a number of you that are taking advantage of this in 2020, and that is the employer Social Security tax deferral. This is not to be confused with the employee deferral that came out as a part of President Trump's executive order. I think they called it something a little different than an executive order, uh, but that came out at the end of the summer, and that had to do with employees' Social Security tax deferral. At this point, I am not aware of one single client of ours that have taken advantage of that have allowed employees really to do this, or have any employees that were really interested in this, because of course many of us know that that had to be paid back um, in the first quarter of next year. And there was a lot of risk to employers that if the employee left, that the employer would be on the hook for those tax payments. So none of our clients have taken advantage of that. Do not get that confused. This is the employer Social Security tax deferral. This was a part of the CARES Act that was enacted in April. It allowed employers to defer the deposit and payment of employers' portion of Social Security taxes. This deferral period goes up until December 31st. So what that means for you is, as of that last payroll of this year, we will be turning off that functionality. You will not be deferring any more of those taxes. So how do you pay them back? The deferred deposits must be deposited by, so 50% of that amount that you deferred is due by December 31st, 2021. And then the remaining amount is due by December 31st, 2022. So one thing that's really important, because I have had clients ask this, and we reviewed this in our year-end webinar, but we think it's so important that we want to cover it again. So I've had clients ask, well, I'm thinking of paying 25%, maybe in January, another 30% by June. It doesn't work that way. You must pay back the amounts owed by, we need to look at the individual amounts held by pay date. We can't just slice and dice this different ways and pay it back on different dates. I'm going to give you an example on the next slide here. So in this example, the employer had 5 pay dates where they deferred a total of $125,000 of employer Social Security tax for the year. So you can see the amount here that is deferred on each pay date. So since the total amount of taxes is deferred was 125, you take 50% of that. That means a minimum of 62,500 is due by December 31st, 2021. So we need to look at the individual pay dates above that I have listed here to get to the point where we exceed the 62,500. So in this case, the employer exceeds the amount. So if we add up pay date 2, 3, and 4, we get to that amount. If you were just to do pay date 1, 2, and 3, we're only at 60,000. So to get above that 50% that is owed, you would then need to look at pay date 4, which has an additional 15,000. So the total amount due by December 31st would be that 75,000 that we must remit and take care of by December 31st, 2021. The remaining amount of 50,000 from pay date 5 can be paid by December 31st, 2022. So, the reason that we're doing this is it's the cleanest way that we can apply the payments and make sure they're applied correctly in the correct quarters. And if you have any issues with this or concerns, feel free to reach out to me directly. But in just working with the IRS and we just feel that this is the best way to be able to handle this as far as making those repayments next year and in 2022. And if we do not hear from you, we will reach out to you in November of next year. We're going to let you know what that total amount is and the associated pay dates. And we will need you to make sure that those payments are in by December 31st, 2021 for that first 50% of the amount that you have owed. So that wraps up our webinar for today. If you have any questions, feel free to send them to me directly. And then if you have any questions on the PPP loan forgiveness, you can email those to Mike Radich. We have his email here. And we will be sending a copy of this slideshow out. We hope that you have a healthy and happy holiday. And here's to 2021. Thanks, everyone. Have a great day.